age where essentially every discount stock brokerage in the US has no commission trading, you may be wondering, how do stock brokerages make money at this point? Well, in this video, we'll go over 7 different ways that stock brokerages make money. The first one is the most important in understanding how no commission trading came about, and that's payment for order flow, or PFOF. This is where a market maker, like Citadel in Robinhood's case, will pay for Robinhood to divert the orders made by users at Robinhood to their services. A market maker provides stock markets with increased trading volume and liquidity, as they'll help fulfill outstanding market orders by buying or selling securities when needed. So Citadel pays a broker like Robinhood. Robinhood routes user trades to Citadel, and then Citadel profits from fulfilling those trades through the difference in the bid-ask spread. Essentially, Citadel scrapes pennies off of any given trade as a transaction happens. Payment for order flow has been criticized because brokerages like Robinhood are sending user trades to Citadel, who's incentivized to give you a worse trade execution price so they make more money. Do I think the manipulation is occurring? Well, as Charlie Munger says, show me the incentive and I'll show you the outcome. So I would assume it is to some extent. But at the end of the day, PFOF is the only reason we have no commission trading in the US. And does the execution price of your trades potentially being worse outweigh the payment for commissions on trading? Who knows? Depending on what part of the world you live in, every brokerage probably has PFOF or none of them have it, because your country's banned it. We've seen that happen with the MAS in Singapore, as well as the UK, EU, and Canada. So plenty of nations think it's bad enough to ban. The second way brokerages make money is on your uninvested cash sitting in your account. Some brokerages will take that cash and invest it in money market mutual funds until you go to invest it or withdraw it. If you're investing with a bank that also has brokerage services, like JP Morgan, your money might be in a bank sweep program as well. This is where your money is put into a deposit account at the bank so they can invest it. Whether you get any sort of return on the investments these brokerages make on the back end depends on your brokerage. But keep in mind, all of this just happens in the background. Your cash is still technically in your account if you want to withdraw, like how typical banking operations work. The third way brokerages make money is on margin. Margin essentially acts like debt, where you're borrowing money from your brokerage to invest in even more stocks than you could otherwise. And while you're borrowing money, you're paying interest on that leverage. So brokerages make money off of that. If you're a beginner, I would avoid margin. Don't even worry about it right now, and I can't be any clearer about that. Number 4 is account fees. Here's a chart from Fidelity comparing themselves to Charles Schwab and Vanguard. The comparison isn't very relevant for this video, but I'm showing you this chart to point out just how many possible fees there can be at brokerages. Account service fees, low balance fees, account transfers, also known as ACAT fees, late settlement fees, wire transfers. The list is longer than that. Ultimately, it's always best to try to avoid as many of these fees as we can. The fifth way brokerages make money is one that isn't talked about too much. While discount brokerages have gotten rid of commissions, that isn't the case when you go international. International trading fees are just like commissions for US stocks, but anytime you buy a stock on an exchange outside of the nation your brokerage is hosted in. You can see the list of fees for all the countries that Fidelity offers access to in their brokerage services. Now, you always have to pay a commission if you're buying foreign stocks. And the fees are certainly going to be even higher if a broker is helping you place those trades. Number 6 is stock lending. This is where your brokerage will lend out your shares to short sellers that are betting against the stock you own. The investor who's being lent those shares has to pay a stock loan fee to the brokerage. The revenue generated from lending out your shares is often shared with you, so you can make some extra money through allowing your shares to be lent out if you'd like. The brokerage has to ask for your consent to be able to lend out your shares. Your stock holdings ultimately shouldn't be at risk unless your brokerage goes bankrupt. And even then, you should be okay because of SIPC protections for investors, which insures up to $500,000 in securities at any member brokerage. So you won't lose anything if the broker is SIPC insured. We'll talk more about that in another video. For the 7th way to make money, not all brokerages have this, but we have membership fees, or subscription fees. Brokerages like Robinhood offer services like Robinhood Gold, which allows you to have higher interest rates on uninvested cash, access to market data, and margin investing. This is something that a standard brokerage account at Robinhood doesn't have access to, yet they block those features off behind a paywall. So some brokerages have memberships where you can get additional perks if you'd like. So these are 7 different ways that brokerages make money in their operations. This video is a part of a larger video series on my channel about learning stock market basics. If you'd like to learn more, then that playlist will be linked in the YouTube cards and in the description below. Thanks for watching.